So, hi everyone. I'm here with Damien Burke today, and Damien's our partner at Foremost, who's specialising in credit risk and modelling, and a lot of sort of insight across the credit industry. So, Damien, thanks very much for joining me today.
No problem.
So I thought it'd be interesting. You'd have quite an interesting perspective, just given what your background is in terms of what you've seen from, particularly from a credit risk point of view, and some of the modelling point of view over the last sort of 18 months. I mean, how have you sort of seen that changed? I mean, we were chatting a little bit earlier around, the fact that it just seemed like it was really busy at the start, operationally, and then it's sort of like, but then there's been a lot of sort of like, credit risk kind of questions, I suppose.
Yeah, so I think our client's real initial focus was operationally, how do we get people working from home? How do we make sure that we're able to sort of service our customers? And there was a lot of expectation from the FCA on that in terms of, making sure that those banking facilities were still operational. Mm-hmm. I think probably after about 4 to 6 weeks that kind of changed a little bit. So some of it was driven obviously by the PRA and FCA guidance on moratoria, payment holidays, and all that sort of stuff. The kind of upshot of all of that was, there was then kind of more guidance around, well, what does it mean for provisioning, for example? So what may have been a traditional kind of stage 2 trigger, and for those that aren't living and breathing IFRS 9 every day, effectively means that there's been some significant increase in the credit risk of the underlying assets, so the loan itself. May not be a trigger in COVID times. So a payment holiday could even have been a forbearance trigger and a stage 3 or default trigger. And obviously that wouldn't be appropriate going forward. So there was a lot of kind of operational changes and actually just getting some of that kind of tied up. And I think there was also an awful lot of change around the kind of customer interaction. So frankly, they had to spend the time initially on MI, which they wouldn't have had to consider before, or sort of more online self-service tools, so that the customer could input some of that information without necessarily speaking to customer services or collections agent, for example.
So I did notice that, I mean, there was a lot of sort of like extra revisions that were basically put in as a result of, I suppose, the payment holidays that came in, and it seemed like there was a lot of uncertainty in the early days. And I saw some reports saying that the recent bank results, a lot of that seems like that's got released, in recent times. I mean, were we just like overcautious? Also with that, I mean, are we undercautious now? I mean, is there any kind of risk in terms of where we sit today?
I think the level of cautiousness really came around from the level of uncertainty, right? So the whole way through the pandemic, we've never really been able to say, with any real confidence of what's going to happen in the next even 3 to 4 weeks. So you talk about or you think about rather the situation at the moment. I think it's on the 21st of June. Everything's supposed to open up, but yet we've had different variants being present, and different levels of vaccination across the country, and all of those sorts of things. So probably today we would say, or I would say personally, that I'm 90% sure that things will open up in the sort of 3/4 of the way through June, but it might not. So anytime you introduce uncertainty in terms of those financial results, it's going to introduce caution. It has to. The financial reporting isn't supposed to be about being prudent. It's supposed to reflect expected losses, but there's degrees of uncertainty in how you calculate those things. So again, for those that haven't been living and breathing IFRS 9, it's based on multiple economic scenarios and different degrees of severity of those economic scenarios, and different degrees of likelihood of those scenarios. So those are all things that the people will have been dealing with and trying to understand. I think the other thing we're seeing that, and probably what's changed more over time, both from an operational perspective but also a regulatory perspective, is that these lenders are looking to understand what these changes mean. So IFRS 9 was introduced in 2018, and lots of firms had time to do some level of parallel running. Others maybe didn't, and with any project, you have to make assumptions along the way. So, I think some of our clients would probably say, if they looked back today versus what they did in sort of 2018, 2017 in the run up to IFRS 9 implementation, some of those assumptions maybe not have borne out, and they need to take another look at, well, what does what's the impact, say, of it taking, I don't know, 2 days to run your IFRS 9 calculations. In 2018, that might have been, well, that's fine, because effectively we start the process on working day 2 and we need to report by working day 4. So 2 days is more than acceptable. If it's 2 days, but you also need to run 5 different scenarios because 2021 is so much more uncertain, maybe that's not acceptable anymore.
Yeah.
I think, the other things that they'd be looking at, and indeed we're working with clients on at the moment, is the DMI that comes out of it. So, we can all predict what people may want to see from an accountancy perspective or a credit performance perspective. But once you live with something over the course of 3 years or so, you're going to start finding that actually there's other pieces of information that would be very useful. And there are other pieces of information that actually would drive a different answer. So, kind of operationally, it's a learning process, and I think, regardless of the pandemic, people would still be looking at their solutions now and saying, well, actually, where can we make changes? Where can we make this more useful? I don't think necessarily there's a lack of caution in any current results, and I think actually, probably a number of auditors would have maybe have thought there was an abundance of caution in previous results, but firms obviously, in the round, it's probably better that firms are more cautious than less cautious, particularly when uncertain time.
And I mean, arrears levels have been fairly benign, actually. I think because of really because of the government support. I mean, what's your kind of view on that? Sort of looking out as we stand here today, sort of 6-9 months. What's your view on arrears levels?
What we've done to a degree is squash that sombrero, made any impact slightly lower and slightly more spread out. And I know your background's heavily in collections, as was mine. A lot of the time when we were dealing with customers, it wasn't necessarily that they needed a one specific action that would fundamentally change their prospects in the short term. Typically, people needed time to recover. So, as an example, if you lose your job, and that's fairly unexpected, whether that's you're fired individually or whether that's because your company is closed down, you need time to find another job. A lot of people we see in collections, again, as you will well know, their income generally is fairly irregular. Yes. They might rely on overtime, for example, or they might rely on bonuses.
I mean, it does feel as if, at the start, we were always like, it was very sort of gloomy, and everyone was expecting doom and gloom to sort of happen. I mean, and the government stepped in with the support schemes, which definitely moved things on. But then we're waiting for that to almost finish, and then it was like, well, that doom and gloom is still going to happen. We're expecting a large wave to come through, and it does feel like it's almost been kicked down the road, or it keeps being moved down the road. And I think the question for me is just, well, if it was going to be a big issue back in October last year, it now looks like it's going to be sort of well, even what, June, September, but is it going to be a much smaller issue than it was back in October? And that the answer to that feels to me, from people I spoke, it feels like that's yes. It's going to be less of an issue than we thought it was going to be because of the squashing. I mean, I think you're saying.
Yeah, no, exactly that. So, I mean, you will have seen loads of kind of industry papers going out and loads of, I guess, conferences or whatever. And, probably if you did a word search on tsunami, would have, got lots and lots of hits. I think people were expecting it to be a massive wave of people eventually rolling into arrears and needing that collection support. My personal view is that probably that is going to be less of a problem. And actually, I think a number of the participants in the industry have done a level of hiring. So they're kind of dealing with the situation in, I would say, more traditional means, in terms of they've taken a few more people on board, trained them up, whatever. But my initial expectation was that the only way you're going to deal with this is throwing a lot of technology at it. Now, I still think there's a lot of benefit in doing that. Not only is it a more effective way or maybe efficient way to deal with customers, we also feel that actually there's a lot of customers that respond well to that. It's a difficult situation sometimes talking about personal finances, particularly when things are difficult, and maybe you would get a better response through self-service apps or text messaging, two-way text messaging, or whatever it happens to be. But I think there's also the other element of it, which is very kind of fundamental to us as a firm, is the data you're able to gather by doing that. So it's very difficult to capture good information only based on conversations that you're having with your customers. And I know there's firms out there that do kind of almost like voice identification around vulnerability and all that stuff, but it's still a very difficult thing to do. Whereas if you are capturing information through some sort of standardized form or whatever else, you would learn much more about those customers long term.
How much on the data side, just picking up on the data piece, how much do you think we're using or maximizing the use of data captured through particularly digital journeys, but also it's voice journeys as well? I mean, how much further can we go? I mean, just thinking about almost like the credit risk and the collections industry. I mean, have we gone far enough, or do you think that can go further?
Yeah, so definitely we can go further, right? That's definitely the right answer. Where do we go further is a slightly different question. So I think there is probably an awful lot that lenders can do generally to improve the capture of, I would say, more sort of structured traditional data. So, one of the things, for example, that we think would be very, very valuable is if you were to keep more up-to-date records of the type of industry that somebody works in. So had we captured that information as an industry and tried to keep up to date with that, we would have had a better view at which customers were at risk, and then how do we help them more directly, more quickly. We could have prioritized those customers over other customers. The other side of it is we would have been able to more quickly get a sense of what does it do to the financials. So what does it do for provisioning, impairment, what does it do for capital or whatever, if we were able to identify those customers individually. So I think there's definitely a sense of, well, we could record data much better that is already probably at hand. There seems to be a slight shift in focus. So we are seeing more and more, and there was a paper out by the FCA recently on it, more around that kind of customer journey, customer outcomes, all of this sort of stuff. Now, I've got to say that there's always been an element of that, and certainly throughout most of my career there's been some level of focus on that. But the paper the other day was about consumer duty. I came across it, but it was essentially putting much higher expectations, I think, on understanding the customer journey, understanding the kind of customer treatment through that journey, and what impact it has on outcomes. So you could apply that to collections, for example, with some clients at the moment, where effectively the questions they're being asked is, well, actually, how do you know that was the right treatment? And I would say traditionally, the way lenders might look at that is, well, let's look, for example, where complaints lie. Yeah. And if we have a number of complaints that we, probably wrap up in the same sort of category, how do we walk back through those kind of customer touch points and say, well, did we do the right thing by the customer, right? And depending on the outcome of that, what's the resolution? I think there's a bit more of an expectation now that you're doing that almost in live, almost active, right? So
I mean, in some ways, that's almost like the arc that they've been going on. You think about persistent debt as an example, and those kind of things. And I suppose it's when you're having a conversation with a customer, it's almost like, is it sustainable? Is it the right outcome? And I suppose almost like those sustainability outputs, almost like so was it an agreement that was going to be sustainable over the longer term and actually help the customer, versus something else then happened that meant it didn't, if you sort of mean. Is that your kind of sense?
Yeah, so I think it's, we've seen fines recently. So I think Lloyd's got fined something like 60 million last year. That was actually, for practices going back some years to essentially those fines were all about individual customer circumstances and understanding that. I think it's another iteration of that. It's, yes, we can put a rule set around it, but there'll be variances in that. Right? We need to be able to give the right customer outcome. That's the policy, right? How do you then deliver that in a way which is easy for the collections agent, and then more often achieves the right outcome for a customer, and we're able to record that outcome in a reliable fashion, right? And assess it. So I think that's where that granularity comes in. So are there pieces of information that if we were capturing about the customer circumstances, we would actually be able to make a better decision? And the collections agent should be less responsible for making that decision to a degree, right? So if I were capturing more information about your circumstances, then I might have found out, for example, that whilst your general income is £800 a month, actually the range of that is £500 to £1,300 a month, right? So actually, a payment plan, certainly a 12-month payment plan, is almost setting you up to fail, right? But critically, we don't capture that information at the moment.
Yeah.
If I did capture that information, then I might restrict the number of tools that I give to the collector to be able to offer to the customer. And I'm only offering a different solution or challenging that if the customer says, I can't do the first one, so it might be a prioritization as opposed to a complete restriction.
Yeah. And I suppose, but there is a balance there, I suppose, from a company point of view between, or almost like from a customer friction point of view as well, which is you're asking 20 questions, 30 questions, and the call lengths go up, and that adds cost to the company, but it also adds customer friction as well to that interaction. And I suppose it feels like there's a balance there. I mean, very much we've been sort of like, well, how do you take cost out? But they're also like, well, this is saying, well, you actually need to add cost in and actually add friction in as well to understand the customer better. And it's like there has to be some sort of balance, I would think.
Definitely agree with that. And where I'm talking about taking some of that information, again, it doesn't necessarily need to come from the customer. It just doesn't necessarily need to be over a conversation. We're trying to identify an income shock to a customer in the short term, and the solution that's there is, well, we'll first of all take information that is possibly 2 or 3 months out of date, because that can happen with credit reference agency data. And then when we do take the data, we'll deliberately exclude the thing that we're trying to identify. So there needs to be a little bit more thought about what are you trying to achieve. Talking about the kind of point in term of versus that kind of time series type approach. So, in my role in Foremost, I've listened to hundreds of collections calls. As I said, that was my first job in financial services in terms of actually making those calls and then training us in terms of it. But often even with those calls, some of those nuances were missed. So you might ask the customer, well, what's gone wrong, right? And they'll say, oh, I've been made unemployed. Okay, well, that might have been what happened originally, and that's important to know, right? But actually, 2 months ago, you agreed a payment plan with us, which was set at the time to try and consider your current circumstances. And now you fail to make that. So what's actually happened in the last 2 months, as well as what happened 18 months ago, and how are they connected? You know, and what I think is the kind of traditional approach would have been, or has been, what did you do as a customer that was wrong, right? So you agreed to me that you're going to pay £100 a month for the next 6 months. You've now failed to do that. How have you failed?
Yeah,
I think the kind of almost call on introspection is, how has the plan failed?
Yeah.
So, for example, did I, or could I have, as a collector, made things more clear? Could I, as an organisation, provide more up-to-date information to the customer about those requirements? I don't know what your memory's like, but if I agreed something 3 months ago, I'm unlikely to remember what I'm supposed to do next month on it.
Yeah.
You know, I probably need some sort of reminder, right? Often that doesn't happen. That you'll get a letter to say you haven't made the payment. You wouldn't get necessarily a text or a phone call or a letter to say,
remember to
you have to make a payment. And some of those things cost money, right? So going back to the balance side, right? Do we introduce cost? So an understanding of whether it costs you more to send a text message reminding versus the cost of then having to call somebody up, write them a letter, spend some time on the phone, additional provisions as a result. What's the balance there? And what are the other methods? So push notifications on an app, for example, you know, is that enough to remind somebody? You know, there's I guess that kind of introspection is really what I'm driving at. There's a lot that could be done. Trying to make an assessment of the value of that to a firm and the value to the collection, or sorry, the customer experience is really where I think it needs to go.
It does feel like it's sort of changing round. Not that it wasn't before, but it's definitely that sort of like customer centric and sort of really putting yourself in their mind around it. And how do you do that? And then how do you balance that against what's right for the company as well? You know, and it's like trying to solve that puzzle almost, like that equation to a certain extent.
Yeah, no, absolutely. And I don't think the regulator is saying, you know, just forgive all your debt. You know, I think there's an understanding that there's a level of customer responsibility, and you know, there's an obligation to your lender to pay that money back. It's more about, well, are you helping the customer to do that? You know, critically, if you don't capture the information on those customer journeys, how would you even know? That's the kind of crux.
And just going back to the economy really quickly, I was going to just give a bit of an anecdote. So I was out and about the other day, which is the first time I've been out for the longest time. I've been sort of stuck inside. I think feels like a year, which was great to be. It was great to be out and about. But one of the things I definitely noticed was how quickly I fell back into old habits.
Right.
So I bought my Starbucks. I didn't go to Pret, which I normally do, but I went to Cafe Nero and did a lot of those things. But just that, I thought that was quite interesting, just to, like, how quickly I went back to the way I was, rather as soon as I was allowed to, versus what maybe I thought I would do. Because things have been very different the last year, and I just wonder if that's a bit of an insight on the economy and how quickly the economy is going to bounce back if they sort of, the more they take the brakes off to a certain extent. That being said, there were one or two places that were closed and they looked like they weren't opening. I mean, there were a couple of places I go to eat and they just weren't opening. You could see that they closed down, and there, letters on the floor and all sorts of things. So it just feels like it's going to be very sort of like sectorial driven in terms of like some pieces again are almost like they either have been minimally impacted or they they'll bounce back really quickly. But then there's going to be this other sort of like segment that's going to it's going to be insolvent. It's just going to sort of really struggle. And it's that sort of like finding that seems like a bit of the challenge.
So it's interesting because I think you kind of hit the nail on the head there, right?
Mm.
You'll go back into, or you'll slip back easy into those habits, I think, of things that you like to do.
Mm.
And you'll avoid slipping back to those habits of things that you don't like to do,
Mm.
right? So I personally used to do an awful lot of travel for work, and a lot of international travel as well.
Yeah.
I will strongly object if somebody says, "Do you know what, Damien? We've got a project in Malaysia. Can you go out next week and spend 2 weeks out there?" Probably, no, I don't fancy that because it's really tiring and lovely people and had a great time out there generally, but it's really hard work.
Yeah.
If somebody said to me, "Do you know what, Damien? We're going to pay for you to go out on a holiday in Malaysia for 2 weeks. Bring your family." I'd be like, "Great," So it's a different thing, right? I think the people that are likely to succeed and the sectors of economy that are likely to succeed are going to be those that appeal to good experience.
So just, I suppose, just as we look forward then, I mean, what do you think is sort of going to be the big developments? What should we be thinking about now? Either from a risk point of view, but then also just from a future point of view, do you think?
So there's a number of areas that I do think are going to be impacted. So you said about COVID being not completely unexpected, but unlikely, right? Most firms, I would say, there were exceptions, when developing their IFRS 9 solution, would have gone with 3 economic scenarios. So a baseline, an upside, and a downside. The PRA were pushing already prior to COVID that probably that wasn't enough. And they did generally promote that more scenarios were better. So, and they specifically said a more severe downside, less likely more severe downside. So I think there's probably going to be certainly much more expectation that 4 is the minimum. It may well be that 5 or 6 become more commonplace. And again, that partly that's, well, it's possible, it's achievable. Partly it's because actually, as we understand those models better, that the thought of having 5 or 6 is probably not as scary now as it was back in 2017 when we didn't have to consider them. I think the other area, and this is directly linked, is MI and understanding, right? So again, back in sort of 2017 when backs to the walls in terms of trying to get everything complete in time and trying to make sure that the models were tested and the disclosures were right and all those sorts of things. I would say probably MI was missed or maybe given a bit of a second thought. And I think one of the things that we've heard from our clients is actually through the firms that did invest in that and did make time for it, either because they started earlier or threw more people on it or whatever else, had a much easier time through COVID explaining some of these things and what was going on than those firms that maybe didn't give themselves enough time and maybe kind of decided to live with it up until COVID. So I think the MI and monitoring and general governance around models has to change, has to be better. And I think the other thing, which is probably less connected in terms of direct kind of cause and effect, but probably is more of that kind of read the room type stuff, right? Is going to be around that kind of collections treatment, and if and when it does happen, what is the solution? Again, kind of coupled with that kind of consumer duty stuff, there's been releases from the Bank of England and I think HM Treasury as well around the role of financial services in the recovery. So, and thus far we've talked an awful lot about consumers, right? Let's not forget a lot of the government support and a lot of the kind of where the lending firms stepped in was around the SMEs and corporates, right?
C-bills and bounce back loans,
exactly. So there's a paper out a couple of weeks ago where they were talking about the expectation is not just that financial services will provide effectively loans, it's support through the recovery period. I think one of the papers talked about essentially not letting a viable company fall down. Now, they weren't talking specifically about Sibbles and Bibbles, but they were talking about sort of general kind of customer or client interaction. But the word they used was viable. Now, funny enough, a number of firms actually put that into their treatment around what it meant for provisioning. So if it was considered that you were a viable firm without COVID, i.e. COVID was the factor, then maybe you wouldn't have gone into stage 2. You would have stage 1. When your previous policy would have put you in stage 2 based on the sort of support you've had, right? So it was an interesting choice of words. I don't know if that was based on observation of what the industry were doing around IFRS 9, but certainly kind of tweeted with me to say, well, actually, there's probably a lot of work to do in that financial services sector, industry to support more of those businesses. And let's face it, if businesses fail, then the whole
the consumers, everything crumbles down, right? Yeah.
So no, it's an interesting point, and I do think there'll be a lot of change in the area, and a lot of focus on the financial services industry, as a result of that.
I mean, from my point of view, it sounds like we've got to sort of get the infrastructure right in terms of gathering the extra data to be able to inform them what the strategy is down. So all the stuff we talked about, treatment, and I mean, it will happen, but it's like, how do we gather that data now and make sure we almost get the insight, house in order, because then that just helps us down the road. It feels like, at least, anyway.
Yeah, no, definitely agree with that.
Well, Damien, thanks very much for making the time. I really appreciate it, and I appreciate the insight. It's been fascinating. So thanks very much, and we'll chat soon.
No worries. Thanks, Chris.